U.S. Treasury bills seem to be losing favor with the Reserve Bank of India, stepping up gold holdings to increase India's foreign exchange reserves. India's central bank has shown a preference for increasing gold reserves instead of U.S. Treasury bills to strengthen its foreign exchange holdings, according to recent data from the U.S. Department of Treasury and the Reserve Bank of India. Tuesday, September 2nd, 2025, Maneco 64, home of alternative economics and contrarian views. So yes, gold is not just rising in price and making new all-time highs. We just made a new all-time intraday high today above 3,500. It's also rising from its slumber as a major monetary reserve asset. And of course, the last 50 years or so, or 35 years, have been an aberration. For millennia, of course, gold has been money and has been used as a monetary reserve asset. What we've had in the last 30 to 50 years of countries holding debt or paper as a reserve asset, and in particular treasuries, that's going to go away because it doesn't make any sense to hold debt, because there's no way to extinguish that debt. You can't extinguish that by taking on more debt. Gold allows people and sovereign nations to actually extinguish debt. And the problem, of course, is that with this debt-based system, it keeps growing, right? Because you always have to find the interest to pay that debt. But I think we're on its last legs, and we're going to look at how India is actually in the process of shifting away from treasuries into gold. It's not surprising. There's a story out in the Times of India that we're going to refer to, and I'm also going to refer to a story in the FT this morning that talks about how emerging market countries like Kenya and Sri Lanka are starting to swap their dollar borrowings into other currencies like the yuan, the euro, the Swiss franc, and that kind of puts the excuse me, it takes away the reason for these countries to have to demand dollars and to have a dollar squeeze when things get bad, right? Because they don't have as many loans in dollars. That's another reason why the importance of the dollar as a major reserve asset is waning. And I'm not talking about this just to gloat and like have a go at the US. The reason I've been warning my viewers, and 40 to 50% of my viewers are in the US, is that when this happens, your currency becomes worth less. It happened to the British pound after World War II. And I've spoken about this. There's a research paper from 2020 entitled Zombie International Currency, the Pound Sterling, 1945 to 1973. That was the period when sterling as a major reserve currency really lost its influence. And there's a chart in this article here I want to show you, which shows that it's quite gradual, but then it accelerates. And what's interesting is that the dollar took over this status as a major reserve currency only around 1954. So 9 years after the war finished, 10 years after the Bretton Woods Agreement. So yes, I admit it takes time, but I would say we are well along the way here, where we're gonna. Well, we are actually in 1954, because recently I spoke about how gold as foreign reserves have taken over treasuries as foreign reserves. There's a chart here that you can see from Tavi Costa. So, yeah, we are in 1954, and we're going to continue to see dollar reserves drop and gold reserves go up. So, that's why it's interesting to always look at history. So what happened to Britain from the mid 50s until the early 70s or mid 70s? Well, it was in decline. There was deindustrialization. They had inflation. It wasn't a good time. Britain was called the sick man of Europe, and I know President Trump is trying to turn things around, but I don't think it's going to be as simple. So yeah, that's another thing that I wanted to show you. But let's go to this article in the Times of India really quickly. It's not a long article. It says India's holdings of U.S. Treasury bill down. Gold finds favor in forex reserves, still among top 20 T-bill investors. And by T-bills, I think they mean treasuries in general. Anyway, it says U.S. Treasury bills seem to be losing favor with the Reserve Bank of India, stepping up gold holdings to increase India's foreign exchange reserves. India's central bank has shown a preference for increasing gold reserves instead of U.S. Treasury bills to strengthen its foreign exchange holdings, according to recent data from the U.S. Department of Treasury and the Reserve Bank of India. This is part of a broader global shift towards diversifying national reserves beyond dollar-based assets. The quantity of gold within foreign exchange reserves reached 979.98 metric tons as of June 27th, 2025, rising from 840.76 metric tons recorded on June 28th, 2024. So that's an increase of 36 tons over a year. That's a pretty hefty increase, I would say. As for treasuries, yes, they've gone down from 242 billion in June last year to 227 billion. That's the latest number from June 2025. Yes, as I said, it's gradual, and it was gradual for sterling back in the 50s. But I think the old passage from one of Hemingway's book, when someone asked a character how this person went bankrupt, he said gradually and then suddenly, very quickly. And I think, unfortunately for Uncle Sam, that's the situation. What that will mean, of course, it's not going to mean that the U.S. Treasury or the United States is going to go bankrupt, because countries can always print print the money, issue the debt, and especially the U.S. being such a big, powerful country. But the way it's going to work out is that the dollar is going to be debased massively, just like the British pound, which I think up until beginning of World War II, £1 was $4.87. By 1967, when there was a devaluation by Harold Wilson, it went from 280 to 240, and now, of course, we're near one. We're at 1.3 or thereabouts. So the way it's going to reflect for the dollar, because it's the major reserve currency, is in its price of gold. So the higher gold goes, the less the dollar is going to be worth, and the harder things are going to get for people who hold dollars. And the people who hold dollars, of course, the most and use it the most are the people in the United States. So that's what's going on. And I also said that we'd look at an article in the FT about countries swapping out of US dollar, and that's increasing. There's still a lot of dollar debt by emerging market countries and other countries. I'm not denying that, but the trend is being set here. The article says developing countries swap out a dollar debt to cut borrowing costs. And they're doing that because they're finding lower interest rates in currencies such as the Chinese renminbi and the Swiss franc. That's what's happening. It's not rocket science. So what that does in times of crises, international financial crises and recession, a lot of these emerging markets in the past, their currencies dropped sharply because they couldn't cover their dollar debts because they needed dollars. So they would issue a lot of currency, print money to buy dollars. The dollar surged. And that's kind of the theory behind the dollar milkshake theory, so to speak. But I think that milkshake is becoming more and more diluted. And it also talks about how they're going for the euro, especially this year. It says here companies in emerging markets are also selling more bonds in euros. So when you sell bonds, you're actually borrowing in that currency. This year, with the amount of this debt in issue rising to a record 239 billion as of July, according to JP Morgan, the overall stock of emerging market corporate bonds in dollars totals about 2.5 trillion. So it's still huge, but I think the shift is happening. So that's another reason why there's going to be less demand for dollars. So with that, let's quickly look at the markets this morning. Yesterday, of course, it was Labor Day, so the miners were not trading, but gold and silver rallied quite well. Overnight, we've actually seen gold trade up to a new high, and this is the spot price, not the December futures. The December futures is higher because of the difference. Because if you were to buy a future, you give up on the deposit rate that you get for, let's say, 3 months. In the case of December, it's more like 4 months from now. So it's like the cost of carry, it's added on to the price. That's why the price looks higher. When interest rates were like zero or next to zero, there wasn't much difference between the spot price, let's say now in September, to the price, the December future. So that's the only reason why the futures price is a lot higher. It's called contango. We got up to 35.09. That's an all-time intraday high. The all-time intraday high had been in April, exactly at 3,500. Right now we're at 34.84, so it's 10 to 8 a.m. London time. So we've come off a little bit here. It's still up about $8. Silver is at 40.66, down about 7 cents. The high's been 40.87. So it's still fairly quiet here. I think we're going to see a very interesting session, especially for the miners. We need to see how they react to the move higher since Friday, because gold was at 34.48, the spot price. That's where it settled on Friday. So despite gold right now being off the highs, it's still about almost $40 higher from Friday. And silver, was below 40. We're now at 40.70. What about the stock market? Well, the Dow futures is down 63. The S&P is down 14, and the Nasdaq is down 65 points. The currencies are pretty steady. In terms of the bond market, one thing I noticed yesterday is that European long-term yields are still spiking or rising, albeit still under control, but we need to keep an eye today on the German 30-year, which has reached a multi-year high yesterday, and also the UK 30-year, which is hovering around 565. I think if we get towards 6, that's very troublesome. That market hasn't opened yet, so there's not much going on right now. As for treasuries, we're going to look at the 10-year yield right now. Well, it's at 425. It's unchanged from Friday. The 30-year is the one we need to keep an eye on as well. It seems like the 30-year for all the major countries, the yield is going up, and that's bad news for government finances. We are at 495, up 3 basis points. And of course, this week, the major story is going to be the non-farm payroll number, or the jobs number on Friday. That's going to be a huge number. There is speculation that they might actually come out with a very weak number, so that it might give the Fed an excuse to do a jumbo rate cut. And that was Fed Governor Waller who mentioned that last week, that it all depends, the amount of cut, because they're going to cut, the amount of cut on the 17th of September all depends on this jobs number. So don't forget, Trump changed the head of the BLS after the previous non-farm payroll, because he said the number was too low. But what if he changed this head of the BLS so that they could manufacture a really low number to force the Fed to cut? And there are people that I talk to who have been in the market for decades who even think if we have a very weak and, let's say, negative non-farm payroll, that the Fed could step in even before the 17th of September, or in other words, they could do an intraday or intra meeting cut, which would be I think would show panic by the Fed, and it would put a rocket up and even well, it would propel gold and silver even higher. Yeah, with that, I'm going to wish you all a very good day. Take care. Bye.